Hi, this is Kurt Kringelis, Senior Credit Strategist with ING Investment Management. I would like to take a few minutes to share with you a brief update on the performance of the fixed income markets. The fixed income markets delivered another month of strong excess return performance in October, despite weakness in the equity markets. The securitized sector lagged, but the weakness was concentrated in mortgages. The higher risk CMBS sector performed well. Despite our expectation for excess returns to settle down to a more sustainable pace, that did not happen in October. 2012 is shaping up to be a very good year for the fixed income market. The highest risk sectors have delivered over 1,000 basis points of excess return year to date. Within the investment-grade corporate market, the cyclical industry showed some life after lagging during much of this year's rally. The financial industry performed in line with the market, but for the first time in 5 months it did not outperform. While we remain constructive on the financials, financial spreads have largely closed the gap with industrials, so the industry may not be as dominant of a leader going forward. The communications industry also performed well for the second consecutive month. At times, investors use this industry as a proxy for market exposure, so the recent outperformance could give way if market direction changes. On a year-to-date basis, the financial industry remains the commanding leader in terms of excess return performance. The communications industry moved into an outperforming position last month and added to its outperformance in October. The cyclical industries are still lagging, but they gained some ground last month. The energy industry cut its deficit versus the corporate market in half and now lags by less than 100 basis points. If the market continues to rally through year-end, the energy industry could move into an outperforming position on a year-to-date excess return basis. The corporate market continued to perform well in October despite notable weakness in the equity markets post the initial QE3 bounce. A continued sell-off in equities will likely spill over to the corporate market and lead to some give-back of recent gains. The market has certainty now with respect to the outcome of the U.S. presidential election, but doubt remains as to the outcome of the U.S. fiscal cliff and as to whether global GDP growth can re-accelerate. Generically speaking, we remain constructive on the medium-term prospect for corporate market performance based on strong technical conditions and some improvements in global economic data. But the U.S. fiscal cliff is an elephant in the room that will likely keep us close to home with respect to our positioning until we have more clarity on the outcome.